Do you want to become rich investing in real estate? Do you want to be a millionaire and see it clearly in your future? Are you broke but want to renovate a fixer-upper and add hundreds of thousands of equity to your net worth? Well, we've got the solution for you. Check out our low rates, but not the fine print written right beneath them. But wait, there's more. Don't get over-leveraged with real estate. Make sure you put as much money down as you possibly can because it's safer. And if you get pre-approved now, we'll throw in even more. Have you heard things like this? Has it led to confusion with yourself where you got overly excited about opportunities in real estate that you just couldn't make work and you blamed yourself? Well, good news. It's probably not you. It's the information you've been getting that's not entirely accurate. In today's Mortgage Monday, Christian, Bachelder, and I get into the truths about mortgages. We bust some myths and we give you information so you can avoid getting ripped off by the wrong loan officer. Hello, everybody. Welcome to Mortgage Mondays with David Greene and Christian Bachelder, partners in the One Brokerage and your hosts of the fastest growing BiggerPockets YouTube channel that we have. I don't know if that's confirmed, but I feel like it probably is based on the feedback we've been getting. You guys are loving learning about lending. That was a lot more alliteration than I was intending to say, but it worked out pretty good. Christian, how are you doing today?
I love that. Learning about lending. Say that 3 times fast, right? I'm doing good, David.
And tell everyone where you are, ironically.
Yeah, actually, funny enough, we are recording this right in the middle of me attending a mortgage conference. So I am out here not only trying to share the information with you guys, but I'm out here trying to make sure I'm staying on top of my craft myself.
That's it. So Christian goes out there and learns it and brings it back to us, the masses, so we can all benefit. Today's episode is all about mortgage myths. So let's get into this. These are things that people commonly believe about mortgages, or maybe just a misunderstanding of the concept, and we are going to bust those myths for you guys today. All right, Christian, number 1, do I need 20% down to buy a property?
Yeah, good question. Even seasoned, you guys would be surprised, even seasoned real estate investors have misconceptions about this. And the answer is for primary residences and second homes and some small exceptions for investment properties. You do not need the full 20. For a single family home, for a primary residence, you can put as little as 3% down. That's for a conventional loan. As many of you know, the FHA also allows for 3.5 down. VA allows for 0 if you've been a veteran or military service. Second homes are 10%, also a great option. And the minimum for an investment is actually 15. The reason why you guys don't hear about it very much is because the pricing's not as competitive as the 20. So typically the 20 is the place where you come in for investment properties that is similar with, for those of you that know, our DSCR loan, that would also start around 20%.
All right, awesome. That leads us into our next myth, which is paying PMI is terrible and should never be done. Christian, should people save up from 3.5 or 5% down all the way to 20% down just to avoid PMI?
No, and PMI is not this, scary boogie monster under the bed, right? PMI is basically, you guys can think of it as a tax almost, right? It's a tax to keep your money in your pocket, right? So if you are able to buy a property for 5% as opposed to 20, depending on the value of the property, that can be a difference of tens of, maybe hundreds of thousands of dollars, right? Depending on how expensive the property is. And the PMI is the tax that you basically pay because you're a little bit higher risk, right? People are more likely to default if they don't have as much equity. But if that higher tax makes sense to keep that money in your pocket, maybe for investing in further pursuits or investing in, your retirement or another property, or maybe renovating your property. I know David and his team, a lot of times, instead of putting 20% down on a property, put 5 and use the other 15 to renovate it, right? So now you're getting value add, right? Instead of just putting 20% down on something that's already in existence. So depending on the borrower's solution, 20 could be a good option, but always speak to a broker that knows what both options look like so that they can advise you accordingly.
Yeah, and that is a great point that you point that out. I was sort of in my career for a significant period of time, actually, before it hit me. Rather than putting down 20% to save a couple $100 off of PMI, which, by the way, goes off after it hits a certain point anyways. Unless it's an FHA loan, you're not paying the PMI for the entire time that you have it in most cases. Put the 15% towards fixing up the flooring, the kitchen, the bathroom, adding another unit so you could rent it out, converting the garage, finding some way to add value to the property or create cash flow. You can literally add 6 figures to your net worth buying a fixer-upper property and putting 15% of that money into making the property worth more, which then opens up doors to refinance it, knock that PMI off later now that I just thought about it. So very good point. It is short-sighted to only look at saving off of PMI. Nobody likes it, but that doesn't mean that it's worth waiting another 5 years to save up money to avoid it and letting the real estate prices go up by 6 figures.
And it's the opportunity cost of money, right? I mean, that money in your pocket may be the difference of you getting a deal done that just lands in your lap, right? 5 years down the line or 2 years down the line, whenever it happens. So that's worth something as well.
It's a great point. You just made me think about if you buy the property with PMI and PMI is $200 a month or $300 a month, but the rents go up $100 a year, waiting 3 years, the rents are going to cover the PMI and then it's pure profit after that. Versus if you try to wait to save it up, you missed out on maybe $500, $600, $700 of rent increases that you would have got if you'd bought the property earlier. So there's a little bit of experience. I don't want to call it wisdom because I don't know if I'm all that wise, but experience perspective here. All right. Number 3. Isn't it best to shop for the lowest rate that I can possibly get?
Yeah, and obviously being a mortgage lender, this is probably the most common question, right? And please don't interpret this as rates not important, because it is. It is important that you're working not only with a knowledgeable lender, but a competitive one in terms of cost. The difficulty that you can get yourself in, though, is when there's a race to the bottom where you're trying to get the absolute dollar for dollar cheapest cost. Which a lot of times isn't going to be us, right? If you go work with some company that outsources their call center to India and, you're never able to talk to somebody after 5 o'clock and maybe they don't have access to all the products. Maybe they're only a conventional lender and they don't have jumbo loans or DSCR loans. You never want to find yourself in a position where you can outgrow your loan officer, right? This is the way that I've started to try to tell people is that if your loan officer has the services and the products that allow you to not only purchase right now, but also scale your portfolio, you don't want to start again with somebody who doesn't know what your goals are and try to build it up from scratch, right? So you have to work with somebody who has access to growing with you throughout your investing journey. And I think that's more important and valuable than saving. It's funny, I just ran a sample scenario with somebody who we were getting a quote that, admittingly, the rate was a little bit higher than ours, but I broke it down and it was about a $27 difference a month. Yeah, obviously, there's a lot of things. It's rate, it's service, it's responsiveness, it's communication, but it's also ability to grow with you, I think, is what I would place the most confidence in.
Now, there's also the dynamic. That is when you actually could get a lower rate. It still might not be the best move, but sometimes you think you're getting a lower rate, but you're not. Can you explain what goes on in the lending industry with the bait and switch?
That's a really good question. And funny enough, we just encountered this situation almost exactly where, a lot of times in lending, while 2008 did make a big dent in the industry in terms of predatory lending, unfortunately, a lot of lenders are still dishonest sometimes. And what happened is that our borrower got a quote. We're at, I don't remember the exact numbers, but let's say we're at a 6.5 and the other lender was at a 6. At first glance, it looks great, right? Our loan was locked, theirs was not. And the borrower was being charged 5 points to buy down from 6.5 to a 6. Not just for that section, but they were being charged 5 points total. And it was exorbitantly more expensive than ours was, right? We could have put 5% more down to the down payment at that point, right? And the borrower didn't understand that. All they were comparing was that rate, the 6 to the 6.5 and the corresponding monthly payment, but they weren't realizing it was going to take them $35,000 to buy down to that at closing.
Yeah, that's something that if you don't understand about how the mortgage industry works, it's very easy to call and say, hey, what's your rate? Well, they have a spectrum of rates. So if the loan officer hears you ask that question, they know, oh, I got a sucker. They're going to go with the cheapest rate there is. They don't know if I'm honest. So they quote you the rate with $35,000 in closing costs. If you went to somebody else and they said, what's your rate? They probably quoted you a rate at par. Just, hey, this is an honest rate with normal closing costs. So the one at $35,000 clearly looks superior. You get into escrow at the closing table. You realize I'm bringing $35,000 instead of $12,000 and you're angry, but what are you going to do? You're going to lose the house? That happens with bait and switch. Conversely, if you go to them and say, what are your closing costs? They can do the same thing. They can get you, if a par rate is 6.5, they can quote you at 8 or 8.5 and give you a bunch of seller credits so that your closing costs are almost nothing. And they're like, oh, we can do it for $2,000. And you go, wow, that sounds better than the other person. Let me just go with that. And then when you get to the closing table, you see an 8.5% rate and, poop bricks. So that is one of the reasons that the loan officer you're working with needs to be honest and have integrity and be vetted, because these are two easy ways that you can be taken advantage of. There's probably 200 in this whole thing, even after Dodd-Frank laws and a lot of other things have been passed, that loan officers of different mortgage companies, lenders of different types can absolutely move pieces around that you end up paying for that you were not aware of that are not always disclosed. So shopping for the lowest rate can make you feel like you won, but oftentimes you lose. All right, the next myth: is a 203K loan the best way to buy a property in today's market? And explain, please, what a 203K loan is.
Yeah, David, that's a good question. Now, there's two counterparts to this. There's the conventional home style and the FHA 203K. Both of them are the same thing. Essentially, it's using lending to finance the renovation of a property. And it's a conventional or an FHA loan. So it's a good product. It's a 30-year fixed, low rate, good stuff, right? The idea behind them is that you get a future value appraisal, right, that is considering the value of the property after you do the renovation that you can leverage based on that loan value, which is a really big benefit. It's a good product. The problem with it is that they take about 120 to 150 days to close. You have to pay for all the permits and the designs and the drawings up front, which means you can't finance that part. You can get reimbursed at closing, but that's a large expense from the borrower up front. Another issue is just the timeline, right? When you're trying to write a 30, maybe a 45-day escrow, and your realtor is trying to be really competitive and in an aggressive market, you're not going to get a 120-day escrow accepted, right? I mean, David, how many deals has your real estate team gotten with 150-day escrows accepted, right? It's not many, right? Maybe we had a couple exceptions, but it's not many. And it's just not the norm. So what we typically advise people to do is that you go buy it, get a regular loan, get it done, and then we can use one of these renovation loans to refinance once you own the property. Because who cares if you're on the timeline, you're not purchasing the property, right? Outside of that, though, purchasing with them is going to be very difficult.
Yeah, so in a seller's market, which even though it's a tough market, believe it or not, most markets still have low supply and low days on market, meaning it's a seller's market. The 203K loan is great for the buyer, but sellers don't like them. And then oftentimes when the buyer uses them, they have to jump through all these hoops. So they go to the contractor and say, hey, I'm going to pay you through a 203K loan. The contractor doesn't want to deal with that. So they say, no, thanks, I'm not taking the job. Or if you do get a contractor that's willing to jump through those hoops, it's probably because they don't have a lot of business, which means they're not as good. It's one of those things in real estate that works good theoretically, but in practice, you hardly ever hear about people doing it successfully for a reason. Now, that doesn't stop people from telling you about it because it gets clicks and it gets views and it gets looks, and it's a way of giving hope to someone that doesn't have a lot of cash that they can go to a BRRRR and make a really good deal. So don't fall into that. If you can make it work, great, but you probably need to be in a market where homes are not selling in order to get sellers to take that into consideration. Now, for those that don't have a ton of cash to put down on a big rehab but want to borrow the money, can you briefly explain how bridge loans work and if that's a better option?
Yeah, bridge loans are good options. They can do up to 90% of the loan to cost, which is the renovation plus the purchase of the property. However, they typically require experience to leverage that high. Bridge loans are short-term loans, 6, 12, 18-month loan products, just meant for you to get into a property and get out quickly, whether that's via a refi or a sale. But typically always it involves some sort of renovation, some sort of, maybe construction rarely, or if you're adding units, stuff like that. But they're short-term loans, right? High interest rates, interest only, get in and out of them quickly because you don't want to be paying those 10 to 15% rates for very long.
All right, Christian, that is fantastic, man. Thanks for taking some time out of your conference to come talk to me. I appreciate that. I'm going to let you get back down there so you can fill up that big brain with more information that we can all benefit from on a future Mortgage Monday. Thanks, brother.
Appreciate you, David. Thanks, guys.